The easiest way to understand why the American economy seems to be defying basic economic gravity is to focus on one overwhelming figure that quietly governs everything else. $9 trillion. That is roughly the size of the Federal Reserve's balance sheet at its peak, a number so large that it becomes abstract. It exceeds the combined economic output of several major industrial nations and represents a massive share of everything the United States produces in a year. But the true danger is not the size of the number itself. The danger lies in how the system became dependent on it and why unwinding it may no longer be possible without breaking something far bigger. What began as an emergency response has turned into a permanent structure. Over the past 15 years, the global financial system has been reshaped around the assumption that central bank liquidity will always be available. Prices no longer reflect risk, productivity, or scarcity. They reflect intervention. The market has learned to survive, not on fundamentals, but on injections. And like any addiction, the doses had to grow just to maintain the illusion of normality. The origin of this transformation traces back to the panic of 2008. Financial institutions were collapsing. Credit markets had seized, and the fear of a second Great Depression was real. The Federal Reserve, led at the time by an academic deeply familiar with the failures of the 1930s, made a decision that would redefine modern money. Instead of allowing debt to be purged and prices to reset, the Fed chose expansion. Liquidity would not shrink, it would explode. Before that moment, the Fed's balance sheet had been small and unremarkable, holding just enough short-term government debt to manage the flow of currency. That all changed with the introduction of quantitative easing. Under this policy, money was not printed in a physical sense, but digitally created and used to purchase long-dated government bonds and mortgage securities at massive scale. Interest rates were forced downward, not by market forces, but by design. The housing market was stabilized. Asset prices recovered. Panic subsided. The public was told this was temporary. Once stability returned, the assets would be sold, the excess money removed, and normal market pricing restored. That promise quietly dissolved. When the crisis faded, the balance sheet remained bloated. Attempts to reduce it revealed something unsettling. The economy no longer functioned without it. The first warning came when policymakers merely hinted at slowing the pace of intervention. Markets reacted violently. Bond yields surged, stocks faltered, and capital fled emerging economies. The reaction made one thing clear. The system was no longer responding to earnings, growth, or innovation. It was responding to central bank flow. The lesson was absorbed quickly. Intervention had become embedded. Years later, a new Federal Reserve chair attempted to reverse course. The balance sheet had grown even larger, and the belief returned that normalization was possible. Assets would slowly roll off. Liquidity would gradually be withdrawn. The process was described as mechanical and harmless. Instead, it triggered sharp declines in equities, stress in credit markets, and a sudden tightening of financial conditions. By the end of that year, policymakers retreated. The experiment had failed again. The economy could not tolerate balance sheet reduction. Then came 2020. What followed made previous interventions look modest. When the global economy shut down, the Federal Reserve did not hesitate. Trillions of dollars were created in weeks. Government debt was absorbed at unprecedented speed. Corporate debt, once unthinkable territory, was indirectly backlisted. Risk that once belonged to investors was transferred onto the public balance sheet. The central bank moved from stabilizing markets to effectively underwriting them. The result was predictable. Asset prices surged across the board. Housing, equities, speculative assets, collectibles, anything scarce exploded in value. This was not organic growth. It was a forced migration of capital. When safe returns were eliminated, investors were pushed outward, compelled to take risks simply to preserve purchasing power. The illusion of wealth spread quickly, even as the currency itself weakened. Inflation followed. Not the temporary kind promised by officials, but the structural kind rooted in monetary expansion. The cost of necessities rose sharply. Wages lagged. Purchasing power eroded. In response, the Fed attempted once again to reverse course, shrinking its balance sheet and raising rates. But the same trap remained. The government runs massive deficits and must constantly issue new debt. For years, the central bank was the largest buyer. If that buyer steps back while supply keeps growing, yields rise. Higher yields stress banks, housing, corporations, and the federal budget itself. The system begins to fracture. Liquidity dries up, lending stalls, growth slows. Every attempt at restraint threatens collapse. This is the core contradiction. If the Federal Reserve tightens aggressively, the economy contracts violently. If it eases again, inflation accelerates. There is no clean exit. The financial system has been rebuilt around excess reserves. Remove them, and the machinery stops. The damage extends beyond markets and into the structure of capitalism itself. Easy money has prevented failure. Companies that should have disappeared survived by refinancing instead of innovating. Debt replaced discipline. Productivity stagnated. Capital flowed toward financial engineering rather than real investment. Nowhere is this more visible than among smaller public companies. A growing share cannot generate enough profit to service their debt at current rates. They survive by borrowing to pay old obligations. They appear alive, but they no longer create value. This is the zombie economy, a consequence of prolonged zero-rate policy. Cheap capital also fueled massive stock buybacks. Instead of investing in research, safety, or long-term growth, corporations used borrowed money to inflate earnings per share. Executive compensation soared. Balance sheets weakened. When stress arrived, fragility was exposed. As rates normalized, a reckoning began. Trillions in corporate debt issued at near-zero rates must now be refinanced at much higher costs. For marginal firms, this is fatal. Layoffs rise. Defaults increase. Credit tightens. Entire sectors built on leverage begin to unravel. This creates an impossible choice for policymakers. Allow the purge and face recession, bankruptcies, and political backlash. Intervene again and accelerate currency debasement. Either path carries consequences that can no longer be avoided. The problem now reaches the sovereign level. Interest payments on government debt have exploded, rivaling or exceeding major budget categories. Borrowing is required just to service existing obligations. Debt feeds on itself. In a free market, lenders would demand much higher compensation for this risk. But such rates would render the system insolvent. This is where monetary independence ends. When a government cannot afford market interest rates, the central bank becomes subordinate. Rates must be capped. Liquidity must be supplied. Debt must be monetized. The currency absorbs the cost. The result is a quiet transfer of wealth. New money enters the system through financial institutions and asset markets first. Prices rise later. Those closest to the source benefit. Those paid in wages suffer. Inequality widens, not by accident, but by design. History shows how this resolves. Governments rarely choose austerity. They never choose outright default. They choose devaluation. Obligations are honored in nominal terms, but paid back with cheaper money. Inflation becomes policy. The Federal Reserve's dilemma is not excess capacity. It is dependence. The system cannot function without intervention, yet intervention guarantees long-term erosion. The printing press becomes the only remaining tool. For individuals, the implication is stark. Currency is no longer a neutral store of value. Labor exchanged for depreciating money loses purchasing power over time. Assets that cannot be created by decree become refuges. This is not speculation, it's defense. The Federal Reserve's $9 trillion experiment has reshaped the economy, distorted incentives, and locked policymakers into an irreversible cycle. They cannot stop without causing collapse. They cannot continue without destroying value. That is the problem. And there is no painless solution left. If the first phase of this monetary experiment distorted markets, the second phase threatens to destabilize society itself. Because once inflation becomes embedded, it stops being an economic issue and starts becoming a political one. Prices rising are not just numbers on a chart. They are rent increases, grocery bills, insurance premiums, and tax burdens that quietly consume more of a household's income each year. And unlike asset inflation, which primarily benefits those who already earn wealth, consumer inflation hits everyone, but hurts the bottom hardest. This is why central banks fear inflation more than recessions. A recession can be blamed on cycles, shocks, or bad luck. Inflation erodes trust. It makes people question whether the system is fair, whether their work is being devalued, and whether the future will be worse than the present. Once that belief spreads, no amount of rate hikes can restore confidence quickly. The Federal Reserve understands this, which is why its public messaging has become increasingly contradictory. On one hand, officials insist they are committed to price stability. On the other, they quietly acknowledge that the financial system cannot survive without abundant liquidity. These two goals are no longer compatible. The Fed is attempting to thread a needle that no longer exists. As rates rise, something subtle but dangerous happens inside the banking system. Banks do not simply lend out deposits. They operate on confidence and collateral values. When bond prices fall due to higher rates, the value of bank balance sheets deteriorates. Assets once considered rock solid suddenly show unrealized losses. Technically solvent institutions begin to wobble. Lending standards tighten. Credit creation slows. This is not theory, it is mechanics. We saw a glimpse of this dynamic when several regional banks collapsed after rapid rate increases exposed losses embedded in their bond portfolios. These were not reckless institutions gambling on exotic derivatives. They were victims of duration risk created by years of suppressed yields. When rates finally moved, the damage surfaced all at once. To prevent contagion, authorities intervened again. Depositors were protected. Liquidity facilities were expanded. The message was clear. Stability would be preserved at almost any cost. But every rescue reinforces the same expectation, that risk will be absorbed by the system, rather than punished. Moral hazard deepens. Discipline erodes further. Meanwhile, the labor market tells a fragmented story. Service jobs remain plentiful, while high-paying white-collar roles tied to leveraged growth are disappearing. This is not a typical cyclical slowdown. It is a realignment. Industries that thrived on cheap capital are shrinking. Industries tied to real-world demand persist. The economy is splitting into parallel realities. This bifurcation mirrors what is happening in corporate finance. Companies with large cash reserves and minimal debt are thriving. They earn risk-free returns simply by holding short-term instruments. Their weaker competitors are suffocating under interest expense. This divergence accelerates consolidation. Strong firms acquire distressed ones at discounted valuations. Competition declines. Pricing power concentrates. The very inflation the Fed is trying to suppress is reinforced by market structure. Small businesses suffer the most. Unlike multinational corporations, they lack access to capital markets. They borrow at floating rates. They cannot hedge. When financing costs rise, margins disappear quickly. Closures increase. Local economies hollow out. Entrepreneurship declines. The long-term cost is reduced dynamism, the very thing that once defined American growth. At the same time, the federal government faces its own compounding constraints. As debt grows, interest costs consume a larger share of revenue. This crowds out discretionary spending. Infrastructure, research, education investments that produce future growth are sacrificed to service past obligations. Fiscal policy becomes reactive instead of strategic. This is the essence of fiscal dominance. Monetary policy no longer responds to economic conditions alone. It responds to the government's financing needs. The central bank may speak of independence, but mathematics dictates reality. When debt reaches a certain scale, policy choices narrow to illusion rather than control. This dynamic places enormous pressure on the currency. If yields are capped artificially to protect the treasury, capital seeks alternatives. The currency weakens. Imports become more expensive. Inflation becomes externally reinforced. Attempts to suppress symptoms amplify causes. Globally, this does not go unnoticed. Foreign central banks diversify reserves. Gold accumulation accelerates. Trade settlements increasingly bypass the dollar. None of this happens overnight, but momentum matters. Reserve currency status is not lost in a single crisis. It erodes through repeated policy compromises. Domestically, savers bear the cost. Traditional financial advice, save in cash, buy bonds, rely on pensions fails. In an environment of financial repression, real returns turn negative. Retirement becomes harder. Risk becomes unavoidable, even for conservative households. Stability disappears. This is why volatility becomes permanent. Markets swing not based on innovation or productivity, but on policy expectations. Every data point is interpreted through one lens. Will this force the Fed to pivot? Asset prices become hostage to speculation about liquidity rather than value creation. The longer this persists, the harder the eventual adjustment becomes. Misallocated capital accumulates. Productivity gaps widen. Debt piles higher. The system grows more fragile, even as it appears stable on the surface. Like a structure reinforced with temporary scaffolding, it looks solid until the supports are removed. History offers no examples of painless exits from such conditions. Prolonged monetary distortion always ends the same way, through inflation, restructuring, or both. The only uncertainty is timing. For individuals, this environment demands adaptation, not speculation, but awareness. Understanding that monetary policy is no longer neutral changes how risk must be managed. Diversification becomes necessity rather than strategy. Long-term planning must account for currency dilution as a constant rather than an anomaly. The Federal Reserve did not intend to create this system. Each intervention was rationalized as necessary. Each delay seemed prudent, but cumulative decisions matter more than intent. Temporary measures hardened into permanent architecture. Flexibility turned into dependency. The $9 trillion balance sheet is not just a statistic. It is a symbol of a system that has substituted liquidity for resilience, debt for growth, and intervention for discipline. The longer it persists, the more painful the resolution becomes. And that is the true dilemma. Not whether the Fed will print again, not whether inflation will return, but how persistently. The era of easy normalization is over. What remains is management of decline versus acceleration of distortion. This is not the end of capitalism, but it is the end of the version built on free money and suppressed risk. What replaces it will be harsher, more volatile, and less forgiving. The adjustment is unavoidable. Only the path remains uncertain. What ultimately determines how this story ends is not ideology, politics, or even policy intent. It is arithmetic. Systems built on leverage can ignore reality for years, sometimes decades, but they cannot escape it indefinitely. The Federal Reserve has stretched the credit cycle far beyond its natural lifespan, and now every remaining option carries consequences that are no longer theoretical. When people ask whether the Fed can engineer a soft landing, they are really asking whether it is possible to deflate a multi-decade asset. Bubble cleanse trillions in bad debt, preserve employment, maintain price stability, and keep the government solvent all at the same time. History suggests this is not just unlikely, but impossible. Trade-offs are unavoidable. Someone always pays. The most common misconception is that the Fed still has control. In reality, control was lost the moment the financial system became dependent on excess reserves. From that point forward, policy ceased to be proactive and became reactive. The central bank no longer sets conditions, it responds to fractures. Every intervention buys time, but at the cost of amplifying the next crisis. This is why markets now rally on bad news. Weak economic data no longer signals danger. It signals future liquidity. The worse conditions appear, the more likely intervention becomes. This inversion is a hallmark of late-stage monetary distortion. Price discovery breaks down. Signals invert. Stability becomes fragile, precisely because it is enforced. Eventually, something forces the pivot. It may be a treasury auction that fails. It may be a major pension fund unable to meet obligations. It may be a banking crisis triggered by duration losses, or a geopolitical shock that drains liquidity overnight. The catalyst does not matter. What matters is the response. When that moment arrives, rates will fall not because inflation is solved, but because the system demands relief. Balance sheet reduction will stop. Asset purchases will resume under a new name. Emergency facilities will quietly become permanent again. The narrative will be financial stability, but the function will be monetization. This is where the distinction between nominal and real outcomes becomes critical. Nominally, debts will be paid. Markets may recover. Employment may stabilize. But in real terms, adjusted for purchasing power, the cost will be borne elsewhere. Savings will buy less. Wages will lag. The currency will absorb the shock. Inflation does not need to spiral out of control to be destructive. Persistent inflation of 4 to 6%, sustained over a decade, quietly halves purchasing power. It rewards leverage and punishes prudence. It reshapes behavior. It discourages saving and encourages speculation, not because people are reckless, but because the system leaves no alternative. This is how trust erodes, not through collapse, but through normalization of decay. People stop believing prices reflect value. They stop believing effort guarantees security. They stop believing institutions serve the public rather than preserve themselves. Once that mindset takes hold, stability becomes performative. Globally, the implications are profound. The dollar will not vanish overnight, but its role will continue to evolve. Reserve diversification will accelerate. Trade blocs will hedge. Neutral assets will regain prominence. This is not rebellion, it's risk management. The same instinct guiding individuals now guides nations. Domestically, inequality becomes structural rather than cyclical. Asset ownership defines outcomes. Those who already own scarce assets adapt. Those dependent on wages fall behind. Mobility declines. Social tension rises. Political polarization intensifies, not because people changed, but because the system stopped rewarding participation evenly. This environment also reshapes innovation. Capital becomes conservative. Risk capital concentrates. Breakthroughs still happen, but access narrows. The frontier moves forward unevenly. Productivity gains fail to translate into broad prosperity. Growth becomes abstract rather than felt. None of this means collapse is inevitable. Systems can persist far longer than expected, but persistence is not health. The longer imbalances are sustained, the sharper the eventual adjustment becomes. Stability purchased through distortion accumulates pressure beneath the surface. The tragedy is that the original intention was stabilization, prevent collapse, buy time, preserve employment. Those goals were achieved temporarily, but each delay increased dependency. Each rescue rewrote expectations. What began as support became structure. The Federal Reserve's $9 trillion balance sheet is not just an accounting artifact. It is evidence of a system that no longer clears naturally. It must be managed continuously, like a patient on life support. Remove the support too quickly, and the system fails. Maintain it indefinitely, and vitality never returns. This is the paradox at the heart of modern monetary policy. The tools designed to smooth cycles have eliminated them only to replace them with one prolonged distortion. Volatility did not disappear. It was compressed. And compressed volatility always releases eventually. For individuals, the lesson is not panic, but clarity. Understanding the environment changes how decisions are made. It shifts focus from nominal returns to real resilience, from promises to structures, from faith in policy to awareness of incentives. Money is no longer just a medium of exchange. It is policy output. And policy output is shaped by constraints that favor survival of the system over preservation of value. This does not make policymakers malicious. It makes them trapped. The Fed's problem is not mismanagement. It is inevitability. Once the balance sheet reached this scale, there was no return to normal-only movement between extremes. Tighten until something breaks. Ease until purchasing power erodes. Repeat. That is why the question is no longer whether the Fed will print again. The question is how often, how much, and who pays. And the answer, as history consistently shows, is those farthest from the source. The printing press does not destroy systems overnight. It dissolves them slowly, invisibly, transaction by transaction. By the time the damage is obvious, the alternatives are gone. The Federal Reserve has a $9 trillion problem, and the reason they cannot stop printing money is simple. Stopping would reveal a reality the system can no longer survive. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.